Welcome to another episode of Map Your Money. My name is Arish Nurani, one of your co-hosts, certified financial planner here, joined with Jeff Cohn, another one of our co-hosts, CFA charter holder. How's it going, Jeff?
It's going great, Arish. I'm loving this cool weather. We're starting to see some leaves falling here in Columbus, Ohio, and football just started. Pat's getting kind of an impressive win week 1 against the Bengals. Love to see it.
That was a surprising one for sure. You already jumped the gun with my icebreaker on the day, but it's going to be your favorite part of football season. We got a lot going on.
Yes, yeah. I always go out usually with some friends on Sundays to go watch football. So like that 1 o'clock game, like the first set of games is always a lot of fun. But we're old and we can't stay out for that long. So by the time the 4:30 games come around, we're like back on the couch at home. Kind of chilling, ready to have the dogs. And so, with fall season here, love like opening the windows, feeling that cool air, getting under a couple blankets, having the candles going, and just watching some people beat up on each other over a football. Man, it's a great way to spend a Sunday.
Nothing like it. I'm a big college football fan too, so that's my Saturday as well. So it's funny, but
you still have the youth to help you through that. It would be my Saturday and Sunday. It used to be, but now.
Jeff, it's hard at my age staying on the couch for 24 hours through Saturday and Sunday. It's tough on the body for sure, but we get through it. But we got an awesome episode talking about election and what that means for your portfolio, the economy, the stock market, and then going to do a financial planning topic as well on HSAs. So let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right. So like I alluded to, going to talk about an HSA account. I think it's secretly one of the most powerful retirement vehicles. It's not something we've talked about on the podcast yet, and definitely want to give it its praise and its time. But to have an HSA is a health savings account. So to be eligible to contribute into an HSA account, it needs to be something that your employer offers, and to be able to contribute to it, you have to have what's called a high deductible health plan. And so as long as you have this HDHP plan, you can contribute into an HSA account and say, okay, what's the point of this account? A lot of people use an HSA account. I'd say a lot of people use an HSA account. I wouldn't necessarily say incorrectly, but not as efficiently as you can if you're really trying to max out your retirement benefits. And so the great thing about an HSA, if you look up an HSA, you're looking at the benefits of an HSA, is this triple tax benefit. And so the first is that you're able to contribute into this account pre-tax before your taxes are paid on your paycheck. So it's taken out from your paycheck, goes into this account. From there, it'll grow tax deferred. That's the second benefit. So you can invest it into stocks or bonds and allow that money to grow, and that's tax deferred. And then the tax benefit is when you take that money out, if it's going for medical expenses, then it's completely tax free. If you take it out after 59 and a half, then you're just tax deferred on it. So it's taxed the same way as like your 401k or an IRA. And so awesome advantage to be able to take advantage of a triple tax benefit. And a lot of people will put into this account, maybe they invest a portion and then they have some sort of medical expense and then they use the account. My hack of the day or loophole or way to really maximize your benefit out of an HSA account is actually to pay your medical expenses if you have an HSA account with cash if you're able to. Obviously, there's going to be things that happen and maybe it makes sense to use your HSA account. You don't have the cash flow. But if you're able to, using cash flow for your medical expenses and allowing this money in your HSA account to stay invested and to grow. But when you pay for these medical expenses, to actually record them, either keep the receipts, put them in an Excel spreadsheet, do some way to where you can keep them. I'd recommend keeping them in multiple places. It's going to be a long ledger that you want to keep for a long period of time. And the reason is, as I mentioned, if you take out this money from the HSA for a medical expense, it's actually tax-free. And so that's for paying for a medical expense directly or for reimbursing a prior medical expense. And there's no timeline on when that needs to be used by. So for someone in their 20s, 30s, 40s, 50s, doesn't really matter. Let's say you're in your 30s, for example, and you have to some medical expense that you pay out of pocket. You write it down on this Excel sheet. When you retire, you can actually say, oh, I had this medical expense back when I was in my 30s. I'm now able to take this money out of my HSA account completely tax-free. And so the big benefit of doing that rather than just taking it out right away is you're able to keep that money in the account and have it grow. You want to have it invested and allow it to really grow. And so the goal is hopefully you have this long ledger of different medical expenses, not hoping any ill will on your health, but things rack up. And so you'll have all of these different medical expenses throughout your career. And then all of that portion you can take out from your HSA account completely tax-free. Any remainder would just be tax deferred. So tax just like a traditional IRA or your 401k as well. So pretty interesting tidbit about the HSA account. I feel like a lot of people don't know.
Yeah, that's pretty awesome. And I've heard that one of the benefits of HSAs and something that sets them apart from other health savings plans is that you can roll over any unused contributions year after year, right? Whereas there's some accounts where you have to use what's in there or else it goes away. Use it or lose it, as they say.
Exactly. So an FSA is a use it or lose it type policy, where an HSA, you don't need to touch that money if you don't want to, and really gives you that benefit of investing it, allowing that money to grow, and being another secret retirement benefit. And so when you think about it, if you use this ledger well and take out all this money in retirement, you're putting this money in pre-tax, and then you're going to take it all out after tax. Uncle Sam never really gets his share there. And you're really taking a huge advantage in doing that. But one of the big caveats there is if you're doing this, or even if you have an HSA account and plan to use it for some medical expenses, I can't stress this enough, is make sure you're investing a portion of that money, not just sitting in cash in that account. That's one of the big advantages of the HSA account. And so if you're an individual for 2024, to max it out, you can contribute up to $4,150. And for a family up to $8,300. And so definitely money that can go a long way if you start contributing to it and getting that invested every year.
Yeah, and that's separate, right, from people's IRA contributions and their Roth and everything. This is additional money that they can put in after maxing out everything else.
Exactly. So another way to decrease the amount of taxes you're paying now, as well as potentially decreasing the taxes you pay in retirement. So truly an awesome benefit, and something I implore a lot of people to take advantage of in terms of secretly one of the most powerful retirement vehicles, is the way I like to kind of frame it.
Very cool.
But I know it's semi-related. I mentioned Uncle Sam once, and that's what everyone's talking about, thinking about. I know we have the debate tonight. We're recording here on September 10th, but want to talk about what's going through everyone's minds come November, and that's how the economy and how the stock market does under different party control. And so I know, Jeff, you're about to bombard us with some different graphs. So what do you got for us?
I just got just a couple, just 6, 7, 10 graphs for you here. I'm joking. I only got 3 or 4 here. So I think one of the things that clients are asking us about quite a bit is how much does the election matter for markets and for the economy? Is it true that if we get, somebody in office that we don't like or that we don't disagree with, that's going to be a risk to the economy, a risk to the stock market? And I think these are very normal feelings that people have. Frankly, I heard this in 2016 and 2018, 2020, 2022, and now, here we are in 2024. If I was a betting man, I'd imagine that we'd be hearing some of the similar things in 2028 and in 2032, whenever those elections happen. So this is kind of a normal part of the cycle, I think. But, let's kind of break it down and just look at the facts, right? We have seen a number of different times when Republicans have controlled the government, when Democrats have controlled the government, and we have historical facts of what the economy did during those periods and what the S&P 500 did. So looking all the way back to 1947, we have a chart here that shows the year-over-year percent change in real GDP. So this is the total measure of an economy's production in within the border during a year adjusted for inflation. Since 1947, 11% of the time we've had a Republican-controlled government, and the average GDP growth in those years has been 2.8%. We've had Democrat control about 29% of the time, and the average GDP growth during those periods was 4%. So slightly better than the Republicans' 2.8%. And then when we have divided government, which is most of the time, 61% of the time since 1947, GDP growth rate is 2.7%. Now, some people, Arish, may look at this and say, oh, there you go, like wipe your hands, stop the count, right? Democrats are better for the economy. And I would say, probably not, right? I think there's probably a list of 3-4 pages long of things that impact the economy and markets. And who the president is might be number 2, 3 on page number 2 or 3, right? And so I think there's probably a lot of other things that are influencing how well the economy and stock market does. And one thing I'd point to on this graph is if you look at a lot of the times that we had total Democrat control of the government, it's a lot in the late 40s, early 50s, going into the early 60s, kind of throughout the 60s, a little bit in the late 70s, and then that's basically it. Versus the time we've had total Republican control have been in the mid 2000s and then 2016 to 2018. And so, just looking at those periods from an economic point of view, the late 40s going into the 50s is when the war effort is winding down. We have a lot of troops coming back from war. Baby boomers are now starting to be born, which means in 18 years, we're going to have this huge influx of new participants into the labor force. And this was around the time that women joined the workforce, which was really positive for economic growth. And we had a lot of new machineries and tools and equipment that really helped spur a lot of productivity growth during that time. So is any of that really related to Democrat control of the government in that period? I would argue probably not, right? And so I think for us, we can go back and we can look at these numbers and they're really fun to look at. But really at the end of the day, it's how much does this really matter, right? How much did this really influence it? How predictive is this for future outcomes? And, to me, if Democrats take full control of the White House, I'm not going to make a huge bet that economic growth is about to explode just because of what we see in the historical data. In my opinion, it's probably just other factors within those timeframes that are driving the outcomes that we see, not the factor of who was in the White House, who controls the government.
Definitely. I think that's such a good point in terms of these extraneous economic things that are happening and these other things that are happening in the market and in the economy and our overall landscape that can drive markets. And so I know in 2020, when Biden was elected, we saw a huge rebound in the market. And it wasn't because Biden was necessarily elected, but what was the reason for that, Jeff?
Yeah, it was, let's see. So the election happens on a Tuesday. The next Monday, we got the preliminary results for the phase 3 clinical trial of Pfizer's COVID vaccine. And in 2020, the economy was locked down and there was a lot of question marks around what does the economy look like going forward? Will we be able to, return to normal? Remember, people are worried about this. We're all wearing masks. And then, when the market gets these results that this Pfizer vaccine is, 98%, 99% efficacy rate, that was really positive sign for the economy and for markets at large, which is why you saw a rebound. Not because I would argue that Joe Biden won the presidency.
Certainly.
But to your point, we had a lot of clients that were worried about that outcome because of potential for what it could mean for markets that missed out on this rally because they were too focused, in my opinion, on the wrong thing, right? The right thing was, how are we going to get past COVID? How will these companies, resume to earnings growth, the economy continue growing? Well, we got that answer. It just happened to be kind of aligned with the election.
Certainly. And honestly, if you're to come with one big conclusion and only one conclusion from this part of the pod, I'd say it's staying invested through this period, regardless of what happens in November, would ultimately serve you the best based off of what we've seen historically. And we have a lot of conviction in that. And I know we've mentioned a couple graphs. We're going to reference them a little bit more. If you're just listening, we'll try to describe them But if you want to see the graphs, you can tune in on our YouTube. Just search Map Your Money on YouTube. You'll be able to see the graphs here as well. But I know you hit on GDP and how that looks under a fully Republican government, fully Democratic, and a split government. How does that affect stocks? What does the S&P 500 look like in each of those?
Yeah, okay. So, looking at that same breakdown, right? This is from 1947 to now. And, 61% of the time we have a divided government, 29% of the time Democratic control, 10% of the time, I think it's at 11% on the previous one. Yeah, it's interesting. 10% of the time or 11% is total Republican control. So in this case, what's funny is you would expect economic growth and the S&P 500 returns to be pretty linked, right? And we saw that Republican growth was actually lower than the average Democrat growth. Well, that's not what we see when we look at the returns of the S&P 500. The average return with Republican control is about 13%, and the average return with Democrat control is 9.3%. And then, of course, divided government is even lower at 8.3%. So to your point, Arish, we would advise our clients to stay invested, try to see through the noise that elections typically are. But there's another reason to stay invested. It's because most of the time, the S&P 500 just goes up, and this is something that we teach to a lot of our clients. About 3/4 of the time of calendar years, the S&P 500 ends positively, and that happens regardless of Republican or a Democrat is in the White House, and we've seen that time and time again. And I think all three of these numbers, 8.3% being the lowest one, tells you that you're probably going to do okay either way. And really what you should be focusing, again, is on what you own, the quality of the companies you own, and how they're going to grow their earnings and how they're currently priced. And for us, we see actually quite a bit of opportunity regardless of who ends up in the White House.
Certainly. And I've seen so many of these this year. And as we get closer to November, of different graphs or different stats where it's, if this person's in the White House or this party's in the White House, the stock market does better, or the stock market does better. And you're comparing a performance of, in looking at this data, if it's all Republican government up about 13% versus all Democratic up 9% versus divided 8%. Regardless of the outcome there, if you sell all the cash, you're getting 0%. You're losing out to inflation on average there as well. And so never really any reason to sell all of your investments or go all to cash because of, this person's going to win in November, or this person's going to win in November. I thought you brought up a really good point there, as well as ultimately we're not investing in who's in office. We're investing in the underlying companies. And regardless of who's in office, we're confident that these strong companies are going to find a way to continue to grow their earnings and can do so regardless of the political climate. And that's what we've seen. That's why we see these really high returns for both parties, for divided government, for regardless of what it is there.
Yeah, exactly. I couldn't agree more.
What else you got for us? What other graphs can we jump into here?
Yeah, I think, a couple of more here. So we talked about the economy's performance. We talked about the stock market performance and the way it ends the year, but we haven't really talked about the way it behaves throughout the year. And, this year actually is shaking up pretty similarly to a lot of other election years with a few differences. But I think the main difference is that we're starting to see some volatility happen around the third quarter and going into the fourth quarter here, which is actually something that we see in most election years. There's something that markets really don't like, and it's uncertainty. Really risk is something that markets try to price, and risk is really any kind of potential event, right? And potential kind of implied there is some kind of probability less than 1. And some kind of detrimental event, right? And so uncertainty creates that risk. It creates that potential for a negative event. And so markets have to price that in. How do you price in additional risk in markets? Well, you model in a lower price so that your expected returns are higher down the road, right? And so what we typically see, and what this graph shows, is looking at whether the incumbent party ends up winning the election or the incumbent party ends up losing the election, and the typical path of the S&P 500 as it approaches election day. And I think what's interesting is that in both scenarios, we see a little bit of volatility in markets. If the incumbent party looks like they're about to lose, then we really start to see the market decline. And in both scenarios, the market is positive, kind of leading up to the few months prior to the election. But if the incumbent party is expected to lose, like we start to see in polling and some of that data, then we actually see the S&P 500 start to correct lower and create a little bit of volatility. And that is up until election day. And then usually election day, what happens? That uncertainty is gone. There is no longer this potential for something weird to happen. We have now closed the book on the election. We are moving forward. The president is choosing his cabinet. We're getting ready for inauguration, et cetera, et cetera. And we typically see the S&P 500 rally to end the year. So, a couple of takeaways there is, for us, there's a lot of things that influence the economy and markets more than just who sits in the White House. But stocks love to price in all these uncertainties and risk. And so sometimes you will see some of that volatility happen in markets. We've certainly seen it this year at the beginning of last month in August. But regardless of that, markets typically end the year positive in election years. And that's what we've typically seen. We've typically seen any kind of risk and volatility is short-lived, because the uncertainty that the market hates is really only temporary, and it only takes up until that Tuesday in November to really get certainty on what the government's going to look like going forward.
Yeah, Jeff, I guess just to play devil's advocate here and want to kind of hear the way you would frame this. I know a lot of people have kind of heard or maybe have seen that October is the worst month for investing historically compared with its returns. And then we now mentioned that, okay, if the incumbent party loses, we sort of see this extra volatility going in to the election regardless. And so what would kind of your thoughts be, or what would you say to someone who's skittish to want to invest or skittish to stay in the market because of these kind of things? And what would be kind of a reason to probably stay invested through the year rather than try to time out?
Yeah, I mean, so number one, I think, is trying to understand the difference between like campaign promises and what is likely to happen. I think we all know that politicians really have an incentive for one thing, and it's to get elected and remain in power, stay elected. So they're going to say a lot of things to try to get elected. And we as investors have to be able to see through that noise and understand, okay, well, what's like an actual likely policy outcome here, and how is that going to affect the underlying investments that we hold, right? And usually that effect is pretty small, right? Another one is, okay, what are some campaign promises that maybe are getting some traction but are unlikely to really see the light of day in what is a very divided government that we have? What's interesting is a divided government is not necessarily a bad thing for investors, because it usually means we keep more of the same, and we kind of keep going down the path that we've been down, which for the market creates a lot of certainty, creates a lot of consistency, and is welcome. And so when you look at new candidates come in, what you want to think about is, will they be able to pass this proposal through a divided government? So you think about like Kamala's, the vice president's tax proposal on unrealized capital gains. And there's been a lot of ink and trees shed to explain why that's a bad idea or a good idea from different people that try to figure that stuff out. For us, it just seems unlikely it will ever happen, right? Because we know that there's tremendous amount of Republican opposition to it. Republicans still control about half of Congress, and that's probably going to continue after this election. And even some of the Democrats, the people on the Democrat side, probably wouldn't support that either, even though generally you would think they would be more favorable to it, right? So I think that those are the things that it's good to cut through the noise and kind of remember, at the end of the day, what are you investing in? You're investing in businesses that are run by the most skilled executives in the world, that are able to run their company and maximize shareholder value regardless of the regulatory environment, the political environment, and the economic environment. And that's what they get paid to do. And we have all kinds of track record going back 100 years to see how good they are at doing that. And guess what? The S&P 500 average return is pretty dang good. And I think that speaks to their track record. So for me, a lot of things create volatility in markets for no reason and are buying opportunities. Elections are typically one of those things.
Certainly. And I think sometimes I know just today we've only really been talking about the S&P 500, but like we mentioned in our last episode, the market's so much more than that. There's so many other places that you can and should be investing as well, into small cap companies, into international companies, into fixed income on bonds as well. And all of those are other areas of the market that are going to be that are going to react differently to different things. And that's what you want. You want that diversification and that added level there. And so want to pull up this graph you have on the bottom of the third page here on the screen. And another reason why you shouldn't really try to ever time the market for, hey, I only want to stay invested if there's a Democrat in office or a Republican. You can see this green line here as if you're invested the entire time. And as expected, I do believe this is the S&P 500. Yeah. But regardless, as expected, that staying invested the entire time greatly outperforms the others. And I'd also mention, I know we're kind of talking about the people that already have their money invested. For people who have money on the sidelines and might be skittish or scared to invest, I would argue that there's always going to be something in the news or something that's out there that's going to scare you from wanting to invest. And I know we just mentioned that there's a lot of volatility. I think an interesting strategy, I know it's one that we've deployed for a lot of clients, is dollar cost averaging into the market. And so you have X amount of money, let's call it 120,000 that you want to invest. Maybe instead of putting all of that in at once, we say, okay, let's periodically invest each month. Maybe we do 6 months, maybe we do 12 months, and put in 10,000 a month for a year. And so even if the market goes down in the short term, that would actually benefit you because you'd be able to purchase at lower prices. And if it doesn't, that's more than okay too. You weren't fully sitting on the sidelines. You're periodically getting in a structured way. So I think that's a really good way and a good strategy to say, okay, I'm too scared because what if the market goes down and I don't know what to do. It's kind of a good way to average out getting into the market, dipping your toes into the water rather than diving into the deep end all at once.
Yeah, I agree. I think dollar cost averaging is a great way to kind of gradually get exposure to markets, kind of get your feet wet a little bit if you're a little afraid of the cold, as they say. And I think this chart is very compelling, Arish. I mean, you have, if you invested the entire time from January 1st, 1970 to the end of last year, or if you just invested with only Democrats and Republicans. And it's funny, I know people that would be beholden to either of these investment strategies, right? Thinking it's better for one or the other. But there's a lot of periods that you can think of where you have really good stock returns where people would have missed out on during a Republican or during a Democrat president, right? I mean, the 1990s were very fruitful, and that's when Clinton was president. Obama came in right at the bottom of the great financial crisis, so I think S&P rose 400% during his presidency, and then Trump had really great 4 years, right? So I think there's been a lot of examples for us. It's like, hey, you have to really put that aside and really think about what are you actually investing in at the end of the day, and how much is a federal president at the White House that has a ton of checks and balances and people he has to answer to, and all kinds of divided government people telling him no and overriding his votes. I mean, it's tough for them to really mess up too much. And at the end of the day, what do these executives do on the next Monday morning, that Wednesday morning after the election? They go and maximize shareholder value for you.
Certainly. Well, great time picking your brain, Jeff. I definitely think this is something that's super top of mind for all listeners as we get closer and closer to November. And as people's open enrollment come around, if you have an HSA, definitely recommend taking advantage of that as well. But before we log off, Jeff, I'm gonna put you on the spot. What's your Super Bowl prediction so we can come back to this in February?
Can't count out the Chiefs, right?
I think that's the easy bet. I think you got it right last year. I think we did this. I think you might have killed it last year.
I think it was like in the wild card round, and I imagined like maybe the Niners would pull something off, but I think I said don't count out Kansas City, right? And Pat Mahomes is just a freak, so how are you going to bet against him? You can't. And they have T Swift now. I mean, come on, that's going to be a good luck charm.
They got the whole Swiftie Nation behind them.
She's worth more than all of them combined. That's got to be weird, right?
It is a different dynamic for sure.
It's awesome.
But all right, thanks, Jeff. Thanks for tuning in. Make sure to check out our YouTube if you're just listening, and you can see all the graphs that we talked about as well.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice.
It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Beam Wealth Advisors, DBA Benedetti Gooser and Associates. All examples are hypothetical and for illustrative purposes only. Beam Wealth Advisors, DBA Benedetti Gooser and Associates does not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.